Hello guys, you are welcome back to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting. Hello guys, you are welcome back to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting. Hello guys, you are welcome back to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting. All right, so welcome back once again to our live session today. So in today's video, we want to consider the fundamental principles of accounting. So if you just joined us, you're welcome back. Please do all to share the video. Make sure to like it as well. If today is your first time on this channel, do all to subscribe to the channel so that we all grow on this channel together with you. So without further ado, let's get started. Fundamental principles of accounting. You and I know that in every business, financial transactions are a very key parameter that you cannot play with, right? Every business have an aspect of monetary substance that always do occur in the business. And as a matter of fact, as we being an accounting students, we should be able to know how to account for these financial transactions that do occur in this business that we want to talk about. So when we talk about accounting or financial accounting has to do with the three things here. We are talking about three things here. The identification stage, identification or identify. In financial accounting, we identify, okay? After identification, you move on to what we call measuring. You measure. So measuring, and then you record. So let's stay here and then let's explain these parameters. So as I'm saying, when it comes to accounting, we identify, we measure, we record. So what is the identification process here talking about here? The identification process has to do with what? Two things here. We talk about what? Collection, and then analyze. Analyze. Collection and analyze. Collection and analyze. What is the meaning of this identification here? Identification here has to do collection and analyze. Before we can get to know that there is any financial transaction that has occurred, we must have some information about that transaction. So in that line, we'll have to get an information. And in getting an information in accounting, we have a name we actually give to it. Let's say you are an employee, or let's say you are an accountant within your business or within an employer's business. And then you have been sent to the bank to actually deposit what? A cash into the business bank account. At the end of the day, when you went to the bank and you made a deposit, the bank will give you a receipt. That shows that you have made what? A deposit. Is that clear? Yeah. So that shows that you have made a deposit in that particular what? Account. And what is happening here? Once they give it to you, you come back and then hand it over to the preparers of this or those who actually enter this information in the business. Okay. So before they can get the information and to enter them within the business, they will get that receipt that they gave to you. In accounting, before we can identify and something to actually to record, we call that item as what? So the receipt that they gave to you, we call it as what? The source document. So under the collection, we have what we call source document. Source what? Document. What is this source document that we are talking about? When we talk about source document, it is actually a document that shows that there have been financial transaction that has occurred. It shows financial transaction, or it shows what? Proof, or it proves that transaction on financial nature has what? Occurred. So before we can identify any item, we need to have what? A collection. And the collection should fetch us the information of what? The source document. So the receipt that the bank will hand it over to the accountant. In accounting, we call it as what? A source document. We call that a source document. So once we get a source document, we analyze the source document. So under this process, we are trying to identify the financial transaction that has occurred. This is what we call the identification process. So identification, we try to analyze whether that transaction have what? A monetary substance. Let's keep in mind that accounting is all about what? Accounting for financial what? Activities. Accounting for financial what? Transaction. Transactions that have what? Financial implication, or that have financial what? Nature. So before we can actually account for it, we need to identify. And at the identification stage, we have the collection and the analysis stage, or the analysis stage, right? And then the collection stage is where we get what we call the source document. In our scenario where the accountant went to the bank and made a deposit, he was actually giving us a receipt to show that he had made a deposit. And under that stage, that's where we identify that there has been financial transaction that has what? Occurred. I believe that is clear. So that is the identification stage. That is the identification stage. So after the identification stage, the next step is to talk about what? The measuring what stage. So now, you went to the bank and deposit that money into the bank account. You ask yourself, what was the amount that you went in to deposit? So for us to know the amount, once we know the amount, that becomes what? The measuring what? Stage. That becomes the measuring stage. So once you know the amount, those amounts will also be found on the source document. For us to know the amount, the measuring stage will also be found on what? On the source what? Document. That is the amount part that we are talking about. So when it comes to the measuring, we want to assign monetary value to the transaction that has occurred. And that too, we'll find that on the source document. On the source document. So that is the measuring stage. That is the measuring stage. We want to analyze, or we want to find out a measure of the transaction that has occurred in terms of monetary what? Value. So we do that by making reference to what? The source document. So once we do that, we have what? Measure the transaction. So once we know the identification by collecting the source document, and we know the value that's attached to the transaction, we then record. We then record. These are the three things that we need to understand when it comes to what? Definition of accounting, or when it comes to accounting for transactions that have monetary what? Substance. That have monetary substance. I believe that is clear. I believe that. So after measuring the item, we move on to the recording stage. So the recording stage has to do with what we call bookkeeping and journal entries. I will explain that. Bookkeeping. So we have what? Bookkeeping and the journal entries. The journal entries. Let me write it up for you. So we have bookkeeping. So we have bookkeeping, bookkeeping, and the journal what? Entries. The journal entry or the journal entries. Let me put it in this way. Bookkeeping and the journal entry. So under the recording stage, that is where we actually record the item in the business books. In the business books. So before we can even record that, since there are a lot of transactions coming here and there, we'll even do some form of what analysis here before we know that okay, this transaction is going to this book, this transaction is going to that book. Because in business and in accounting, every transaction that occurred should have its own separate book that should be what recorded. That is why when we get those information after the identification and measuring, we must also do analysis to know which book should this transaction should occur or should be recorded into, or which transaction should go into this book or that book. So under that stage, we have bookkeeping. So bookkeeping has to do with what? Recording of what? Information that have monetary what? Substance, right? And the journal entry will comes in where we classify these transactions into the various what? Books. So we bookkeeping when we know the book that we want to record a particular transaction in, okay? And then we journalize entries when we know that this transaction, which have monetary substance, is going to this particular book or that book. That is the things that we need to know when it comes to what the recording stage. So we are talking about bookkeeping and journal what entries. So from there, after the recording stage, we move on to what we called. So under the recording stage, you also need to talk about items like, so after the bookkeeping and journal entries, we also have what we call leisure or leisure entry. Leisure entry. Leisure entry. So after recording transactions in the journals, right? At the end of the day, we must sum up all this information and then post them into a ledger. What is a ledger that I'm trying to talk about here? What is a ledger? A ledger is actually an account of all the transactions that have occurred. Let's note that accounting is all about what? Monetary substance. Accounting is all about monetary substance. You can't record any item of without any monetary substance and tell us that is what you are accounting for that. No, then that should be what a non-accounting what item. Because for us to account any item in our books, it should have monetary what substance. That's why we chip in the concept about what measuring. We should be able to have the value for the transaction that has occurred. That has occurred. I hope that is clear. So after the recording in journal entries, we also have what we call ledger entries. Ledger entries has to do with where we transfer all the information, the journal entries, into their various accounts. So ledger entries or ledger account, ledger is the same thing as an account, okay? So after transferring all the information from the journal entry to ledger, in accounting, we call it as what? Posting. We call it as what? Posting. So when you transfer information from the journal entry to the ledger, we call it as what? Posting. And that's what I'm saying. Ledger is actually a summary of all the transactions that has occurred in the journal what? Entry. That has occurred in the journal entries. So once we identify, measure, and record, and after ledger entries, we also prepare what we call the trial balance. Prepare what we call the trial balance. TB, trial balance. What is the trial balance that we are talking about here? Trial balance 2 is actually a balance or a statement actually that lists out all the balances in the, or that lists out all the balance of the transactions that occurred. I'll take it again. That the trial balance is also actually a statement that actually depicts all the balances that has occurred in our books. And I will explain that when we go forward. So after the ledger entry and preparation of the trial balance, that is where we move on to prepare what we call our financial statement. Our financial what? Statement, FS. Our financial statement. But we'll zoom that, or we'll get into financial statement as we move along. I don't want to take you for where you'll be a bit confused. So let's stay here and then let's get what we want to understand when it comes to accounting. So after identifying, measuring, and recording, and doing all this stuff to the financial statement, you then have to communicate those financial statements to people who have concern to the reason why we want to prepare the financial statement. The reason why we want to prepare the financial statement. So after the recording, we move on to what we call the communication stage. Communication. So all these activities actually under what the recording, right? So after the recording stage, we have, so let me chip in that here. We have what we call communication. You need to communicate. So communication. How do you communicate? You communicate through the financial statement that has been prepared by what? The business. You communicate through the financial statement that has been prepared by what? The business. So you communicate to what? People who may have interest in one way or the other in the affairs of the business. And we call those people as what? Users of financial information. We call them as what? Users of financial information. So now you realize that when it comes to the definition of accounting as a broad concept, it actually houses a lot of what? Principles that we need to understand. Because we said, or we are saying that accounting is actually the mother language of every business. Accounting is actually the language that every business must respond to. Before you can account for any financial transactions, you must have knowledge about this word principle or this language that we are talking about as what? Accounting. So let's note that accounting is what? The language that we use in businesses to account for the transactions that has occurred. And these transactions should have what? Monetary substance. Should have monetary substance. So let's take note of that. So after the recording, we do what we call communication. So the communication has to do with where we refer the financial statement to people who may have interest in the affairs of the business, and we do that through communication. And as I said, those people to whom that we communicate the financial statement information to, we call them users of financial what? Information. We call them users of financial information. We call them users of financial what? Information. We call them users of financial what? Information. They will use the financial statement information prepared to actually make what we call economic decisions. Please, let's take note of this. Economic decisions. Economic what? Decisions. So that is the issue about communication. So once we communicate the FS, which is the financial statement, to the users of this financial information, they will use that to make what we call economic decisions. Because every user, as we move along, you get to know that every user have his or her own interest when it comes to financial statement. When it comes to financial statement or the accounting what? Information. Every user has his own interest in the affairs of what? The business. And they will use that to actually make what we call economic what? Decisions. Economic decisions. Economic decisions. So let's take note of that. So after the recording, preparing of financial statement, we communicate. Then it is through this communication that these users of financial information or economic decision makers will actually have to actually analyze that this is the financial information that has been prepared and then communicated to us. So what is the meaning behind this financial statement that has been prepared and communicated to we, the users of what? This information. So they will do what we call analysis, and out of the analysis, they will make what we call interpretation to the analysis or to the financial word statement. So interpretation. So after the communication, there exists what we call analysis and the interpretation of what? The financial information or the financial statement that has been communicated to these users of what? Financial information. And this is what we need to understand when it comes to what? Financial accounting, or when it comes to accounting as a language that we use in business. It must have monetary substance. And before we can account for that, we need to what? Identify. By identification, we need to have what we call a source document. A source document that you know as what? A receipt. In a case of where you've been an accountant and you asked to deposit or you were sent to deposit money to the bank, at the end of the day, you were given a receipt. In accounting, we call that as well the source document, because it will actually shows that there has been a transaction of monetary value that has what occurred. So that becomes the identification stage. And then you move on to the measuring stage where we want to identify or we want to know the value of what the transaction that has occurred in monetary terms. And from there, we'll do what we call our recording. And recording has to do with the bookkeeping and the journal entry. Before we can bookkeeping or before we can record any item, we need to know the journal, or we need to know the book within which we need to record that particular transaction, right? And once you know that, then we record. That is the bookkeeping what process. And from there, once we have done that, we will post every information that occurred in the journal to another account called ledger what account. We call the ledger entry. So once you transfer all the information from the journal entries to the ledger entry, we call that one as what posting. So transferring or moving information from the journal entries to ledger account, we call it as what posting. And as I said, ledger is actually the account that summarizes all the financial information that has occurred in the journal what entry, what has occurred in what in the business. So from there, we prepare the trial balance and we prepare what the financial statement. So once the financial statement is prepared, we move on to communicate this information to users who may have interest in one way or the other in the affairs of the business. And we call these people as what economic decision makers, because they use the financial information to make what economic what sound economic decisions. Sound economic decisions. So from there, that when they are making decisions, they will analyze and then make an interpretation based on what they actually want to know or understand from the financial statement. And this is what we call an accounting. This is what we call an accounting. So accounting has to do the process of or the art of identifying, measuring, and recording of what financial information, and then communicate this information to economic decision makers, and then out of that they will analyze and interpret in order to actually come out with the decision that they're going to make to actually know how their interest is being factored in the affairs of the business. This is what we call an accountant. This is what we call an accountant. And these things that we have discussed is actually the functions of what an accountant is, the functions of an accountant. So let's take note that in every one to account for any financial transaction that occurred, we need to identify, we need to measure, we need to record. These are the three basic elements that you can do away when it comes to definition of what financial accounting. And I believe that is clear. So actually, this actually summarizes the process when it comes to what financial what accounting, or when it comes to what accounting as a language that we use in business. And this concept that actually we are trying to discuss or want to understand from this lesson was actually developed by a German person in early 14th century, 15th, and those end there. We call this man as well Luca Pacioli. Luca Pacioli. He actually coined the term accounting. During that time, they were into what we call bookkeeping, right? But remember, during their time, there wasn't any an item or something called what currency that you exchange what financial activities with, right? For them, they were dealing with what the barter trading what system. And as and when the concept evolves, right, from year to year, from century to century, then there was an introduction of what currency into the system, because it gets to a point where when it comes to exchange of transactions, okay, let's say I have cassava. Let's say I have cassava, you have, let's say, goat. So A have cassava, B have what? Goat. A have cassava, B have what? Goat. And then B wants cassava. And then A also wants what? Goat. What is happening here? Realize that the value for cassava as at now and the value of goat cannot be the same. So we can't exchange this transaction. That becomes a problem of the barter system. And as such, they sat down and realized that no, why don't we develop a kind of system or a platform where we can exchange things of the same value? Hence, the introduction of the currency in the business setting. So the currency came in to solve the problem of what the barter system in terms of what value to be exchanged with what? One another. To be exchanged with one another. And that is where the accounting actually, as a concept or as a discipline, actually has evolved over time till now that we are studying. So this is just a little brief about the concept or the language that we use in business that every manager, that every individual must understand before they can account for financial activities that do occur in a business. Any question at this stage? Any question? Any question? Any question? If there is no question, then we can continue. So after that defines the accounting in that line. So we also discussed the issue about who we called the users of what? Financial what? Information. The users of what? Financial what? Information. But we said that after the financial system has been prepared, it needs to be reported to these users. And these users use the financial information to make sound economic what? Decision. To make sound economic decision. So now you know that financial accounting or accounting is actually has to do with transactions that must be recorded in monetary what? Value. That must be done in monetary what? Value. So let's take note. So let's continue. There was some bit of little interaction that I need to sort out. Sorry for the delay. So as I was discussing or we were saying that after the FS has been prepared, the financial statement needs to be communicated to what? Users. And these users used to make what? Sound financial what? Economic decisions. Sound financial economic decision. So as you know, financial accounting is all about accounting for transactions that have monetary what? Substance. Accounting for transactions that have what? Monetary substance. So let's take note of that. Let's take note of that. Let's take note of that. So when it comes to the users of financial accounting information, for the users, we may have two forms of users. When it comes to financial accounts, we may have two forms of users. These are what we call the internal user. We have what? The internal what? User. And we have the external what? User. And the external user or users. So you have internal users and then external what? Users. Internal users and external users. Who are the internal users? Internal users are actually users of financial accounting information who actually reside or work with the business internally. For example, you may have employees. Employees, right? They may need a financial what? Statement. They may need it actually, or they may need the accounting information. So employees is one of the internal user. What again? Managers. Managers actually also may also need what? The financial statement, right? That's the internal users. We can as well even talk about the capital provider, but that would depend on the side that the capital provider actually what? Reside. For the capital provider, you may have internal capital provider and external capital provider. We'll get there as we move along. So for the internal users, you may have employees, you may have management or managers. But for managers alone, for them, they actually are those people who prepare the financial statement. For them, they need or they use the financial information actually to know the performance of the business, the profitability, how the business can be run on daily basis, and to know how the shareholders what capital is being what actually being used in the business. For them, they need an information called management what information. Though they might need what accounting information, but accounting information of not relevant as to other users. For them, they need an information called management what information management information. That is what actually managers need, because they are those who prepare, and out of that they will bring out the financial statement for we other users to make use of it. So you may have internal user and external user. Internal user may have what employees, managers, and management, and managers, as I've said, they may need what the financial, or they may need the management what information. They may need management information. When we talk about external, we may have two categories. We may have what we call direct. We may have those who are direct users, and we have what indirect what users. So under direct user, we may have what we call shareholders. Shareholders. So that should tell us that when the financial information is prepared, or financial statement is prepared without what communication to users, it has no relevance. So once it is prepared, it needs to be what communicated to what users, so that it have relevance as to the reason why it was prepared. Because you can't prepare financial statement and then keep it yourself. No, it must be published out for people to make sound economic decisions. So it can be a typical case or question that why is financial information actually prepared? The reason is that it's prepared to be communicated to users to make sound economic decision, because they may have an interest in the affairs or how the firm or the business is being what run. That is how come financial information must be communicated to what these users. So as I said, the external user may have direct and then indirect. Direct ones, you may have shareholders as one. Okay, you may also have people like, how should I say, customers. Yes, they may also be a direct external shareholders. So customers, you may have suppliers. Suppliers, you may have suppliers. You may have what lenders, and those people, they are all direct external user. And then indirect ones, we have government coming in. We have government coming in, right? We have government coming in. We also have other groups. Other groups also what coming in there in that case. So these are what we call the users. We have internal user and external user. And as I've said, each user has its own interest in the financial statement. So when we talk about employees, employees need the financial information to ensure that their job or their appointment as what employees is being what secured. So in other words, I want to talk about what we call job what security. Job security. So they need financial information to know whether they are secured with the post that they are being given with to work with the organization. So job security becomes one key thing for an employee, for the reason why they may request for financial statement. And then also to know the performance of the business, the profitability, and the ability of the business to survive for long, so that it can continually pay its wages and what salaries. That is what an employee will actually request or need from the financial what statement. I hope that is clear. And as I said, management or the managers may also need the financial information purposefully to know the performance of the business, how the business is being run on daily to day basis, and to know whether the business can survive for long, so that it can also provide protection to capital providers what fund within the business. Is that okay? So that is also what managers may also need: the solvency, the profitability, and other issues in relation to what the business. Managers may also want those information. As I said, managers, the information that they might need, because they are those who prepare the financial statement, they might also need what we call the management information systems. Actually, that's what they might need what most. Okay, we also have shareholders. Shareholders are actually the capital providers in the business. They need a financial statement or the financial information to know how well their capital is being used, whether their capital is going to be what liquidated. By liquidation, I mean whether it will go into a situation where a capital cannot generate returns anymore or not. So they need the financial information to know whether the business is profitable, right? Whether the business is performing well, and to know how its capital or how their capital is being used within the business. So let's take note of that. We also have customers. Same thing, they might also need to know the performance of the business in order to rely on them on daily supplies of what? Their inventories. But customers are much more concerned about what? The companies or the business inventories that they can actually buy from them to also to resell to their customers in that line. Suppliers also need the financial statement to also to know the credit worthiness of what? The company. Because we can't supply our goods to the company without knowing whether this business is credit worthy, whether we can trust them on long-term basis, and as well to determine whether they can pay our debt in the long-term run. Because it's more like you giving your money to a friend, and then you haven't assessed whether that friend is wealthy, credit worthy, that he or she can pay the money as and when you want it. That is what creditors or suppliers are actually what in need of when it comes to the financial statement. And lenders as well. You also have banks. I mean, these people, they are more similar. Banks, lenders, creditors, suppliers, they all have the same role. They need the financial information. One key thing is to know the credit worthiness of the organization and to know whether the business will survive for a long in that line. So this is what we need to understand when it comes to what the users of financial information as they requesting the financial information to make sound economic decision. So let's take note of that. Let's take note of that in that line. Any question? Any question? So that is for the users and their information needs in the financial statement. But before an information can be used by users or can be communicated to users or people who may have an interest in it, we need to know the nature of the information that has been communicated to these users. And that will lead us to what we call the qualitative characteristics of what? Financial information. Qualitative characteristics. So qualitative characteristics or qualitative features of financial statement or financial information. What are the qualities that shows that this actually a financial information? That is what we need to understand. So when it comes to the qualitative features of financial information, we have two categories. We have what we called the fundamental, how the fundamental qualitative characteristics of what financial statements. We have the fundamental one, and we have the other one called the enhancing. The enhancing. Fundamental and then the enhancing. Fundamental qualitative characteristics of financial statement or financial information actually help us to know one, the true and fair value of the information being prepared, and we'll get to know what the true and fair value of the financial information is. So the fundamental one actually is more like what the champion, let me put it in this way, quote and unquote champion when it comes to qualitative characteristics actually is the main quality of what or qualities of what the financial statement or the financial information. And the enhancing one is more like what the supportive characters in that line. I mean, I want to put in a way where we can easily get it. That the fundamental is more of the main qualitative characteristics of financial statement, and the enhancing is more of the supportive qualitative characteristics. So under the fundamental qualitative of financial information, we also have what we call two categories here. These are what we call the relevance, and we have the faithful representation. Faithful representation. Representation. And when we talk about the enhancing too, we have four broad categories. Sorry. We have four broad categories. These are one, comparability. Comparability. Two, we have understandability. Understandability. Three, We have verifiability, and lastly, we also have what we call timeliness, timeliness or timeline. Please don't check the handwriting. Let's focus. That is what we need to understand. So when we talk about the fundamental, we have relevance and faithful representation. By relevance, we are saying that the financial information which have monetary substance must be relevant in a sense that it should be able to make difference, right, in the decision that's been made by users of financial information. I mean, those by relevant, we mean that the information or the financial information should be able to alter the decision. By alter, it should be able to make changes, all right, or influences the decision that's being made by the user of this financial information. So let's take note of that. So that is the relevant nature of the financial world information. It's capable of what? Making a difference between the decision that is being made by what? Users of what? Financial world information. Difference. It should be able to make difference in the decision being made by users of what? Financial information. So that is the relevant nature of it. I want to talk about the relevant. We also have two aspects that we need to understand. Relevance should have the nature of what we call predictive, what? Value, predictive and confirmatory. Confirmatory what? Value. Confirmatory what? Value. So by predictive, it should be able to have the nature of what? Predicting for the future. The information provided should be able to use to make predictions in the future. That's the predictive nature or the predictive value of what? The financial information. And the relevance, we should be able to make predictions in the future. And when we talk about the confirmatory, it should be said that such information being confirmed by one person can also confirm true by another person. That is the confirmatory value of what? The fundamental quality of the financial information under the relevance. So let's take note of that. So we have predictive value and confirmatory what? Value. And faithful representation actually is also a quality that helps us to understand the true and fair view. That's what I was talking about. The true and fair view of how the financial statement has been what? Presented. And in that, it should be have the following features, three categories, very important. One, it should be neutral. The information presented should be what? Neutral. That's neutrality. It should be neutral. There shouldn't be any other information. By neutrality, you understand what I'm trying to talk about. It should be what? If it is yes, it is yes. If it is no, it is no. Neutrality. There should be nothing or something to mess up with it. Neutrality. Then also, it should also be what? Complete. It should also be what? Complete. Okay? And then it should also be free from what? Error. Free from what we call material what? Errors. Free from what we call material errors. Material errors. And I will explain that. Neutrality, as I've already explained, is neutral. Complete means that the information presented shouldn't be partially presented or halfly presented. It should present 100% fully what? Presented, so that we can use it for making what? Sound economic what? Decision, as we being the user. And then also, it should be free from material error. There shouldn't be any mistakes or any influences that will cause the financial statement to be an advantage to other user without the same to other people. So free from material error means that it should be free from any sort of what? Biases and those kind of stuff. That is the free from material nature we are talking about. So by materiality, we are saying that if something is material, if an error made is material, that means that will alter or that will changes the decision that will be made by what? User of what? The financial information. If it is not material, I mean that it doesn't have the ability to actually influence the decision that will be made by what? The user of what? The financial what? Information. So that is the faithful representation aspect. It should be neutral, complete, and free for what? Material error. And the relevance, you have predictive value and confirmatory value. But relevance should be able to capable of making a difference in a decision being made by these users. And then when we talk about the enhancing, as I said, they are more of a supportive what characteristics. And then we have comparability. Comparability means that if A is saying this is the same thing, then B also should have the same thing to actually compare with. So in terms of comparison, we should have certain features that should make it actually the same for us to what make what comparison. This is what we call the comparability nature of what the enhancing qualitative characteristics of what financial information. That's comparability. Understandability also here is that the quality of the information provided should make it easy for users to what understand. Should make it easy for users to understand or comprehend. That is the understandability nature of what the enhancing qualitative feature of financial statement. Then verifiability is more similar to the confirmatory value. If one person is saying that this is yes in this financial statement, another person who is not there with let's say we have A and B. A is on different region, B is also on different region. So if A is saying yes in the financial statement, B should, all things being equal, saying the financial statement have been prepared and show true and fair value, should also say what? Yes to the financial statement. That is the verifiability, meaning that it can be confirmed by two or more people of the same word information. That is the verifiability nature or the verifiability nature of what the financial information. And lastly, timeliness. Timeliness has to do with where the financial statement or financial information must be presented at the location and place where it can be used for making what sound decision. If it's not presented on time, then it loses what its usefulness. It loses what we call its usefulness. So under timeliness, we are talking about the usefulness of what the financial information. It should be presented on time so that we can use it for making what sound economic decision. Unless it will lose its usefulness, because you can't prepare financial information. Say, for example, I'm just assuming because we have a space data we publish our financial statement. You can't prepare financial statement say in the month of, for example, in the month of say January, and you want to keep it to yourself where we need it to make decision in January, and but you present to us in the month of March. That wouldn't make sense. That wouldn't make sense. So in that line, it will lose its what usefulness in making what decision. That's the timeless nature of what the enhancing qualitative feature of what financial statement. And this is what we need to understand when it comes to the financial statement. When it comes to the financial statement. So now we know the qualitative characteristics, users, and those issues that we need to understand when it comes to that. So through our discussion, you have been mentioning financial statement, financial statement, financial statement. What is this financial statement that we are talking about? The financial statement actually they are statements that are prepared by the business, and that is what we communicate to users actually to identify their interest in the affairs of the business. So under the financial statement, we have 5 categories of financial statement that a business prepare for a formal business. We have one called, I'll use their initial for to save time and for us to move on. We have what we call statement of what? Profit and loss. Statement of what? Profit and loss. We also call it statement of what? Income. Statement of income. Okay. We also have statement of financial what? Position. In old term, we call it as what? The balance sheet. The balance sheet. Okay. We also have statement of changes in equity. Statement of changes in equity. That's also there. And they also have statement of cash flow. Statement of cash flow. I mean, these statements will be dealt with by those who will be measured in accounting. But in our discussion today, we won't just want to understand the basic what principles. So throughout the discussion, you realize that we are going to center our minds or our direction on preparation of financial statement by a sole trader. That's going to be the discussion along the line. And lastly, note to the account. Notes to the account. So these are the 5 financial statements that we prepared when it comes to information that we communicate to users of financial information. So let's take note of that. Let's take note of that. So once we have this information saying financial statement, statement of profit and loss, statement of financial position, statement of changes in equity, statement of cash flow, and note to the account, we'll discuss detailedly as we move on in that line. So statement of financial position talks about the performance of what? The business, performance, and the profitability of the business, whether it's making a profit or loss. Then statement of what? Financial position give us the snapshot of the entity's current position of its capital, of its assets, and those who claim what? Assets within the business. We call that as what? Liabilities. As we move along, you understand all these things that I'm trying to put across. And we also have what we call the statement of changes in equity. It talks about how the capital that's been provided by owners or capital providers what fund is being what changes over a period of what time. Let's say you started with, let's say, 2000. Now you have what? 2300. What has occurred? Your initial 2000 has changed to what? 2300, meaning that it has changed from one period to what? Another. When it occurs like that, a statement called statement of changes in equity is what we use to actually account for that. We also have statement of cash flow, which talks about the inflows and outflow of cash that the business used to transact its what? Operations or activities. The note to the account actually provides a summary to all the accounts that are going to be prepared in the business. It provides a summary so that as and when users take these financial statements, they will know that, okay, the profit nature of this business was as a result of this and that. So the note actually explains briefly or detailedly, depends on the nature of the business, how the business actually is occurring in terms of it what financial or perform in terms of it what financial statement has been provided. So let's take note of that. So in our next discussion, we'll discuss or we'll go through how this financial statement is being prepared and which body actually regulates the preparation of what financial statements and how should that be done. And in that line, we'll discuss what we call the regulatory framework and then the conceptual framework. We'll discuss that in our next section. That is next week. That is next week, Sunday, 5:30 p.m. on this channel, so that we understand how these financial statements are prepared and which body actually governs the preparation of what financial information. So if there is any question at this point, you can let me know before we bring the discussion to an end. Before we bring the discussion to an end. If you haven't liked the video, please do all to like the video and then share it out with your friends and those who may be interested in this kind of videos. If there's no question, then we would like to end here and continue next week, Sunday, 5:30 p.m. on this channel, where we discuss the regulatory and the conceptual framework of accounting and get to understand it better, because these are the basic principles. Once you get these basic principles going forward, it becomes so easy for us to appreciate and understand the concept about what financial accounting and how things should be done or how you should account for transactions that have monetary value within the business. So if there's no question, then I'll end here. So thank you so much for joining us today live section. We are grateful for having you here. Please, today is your first time on this channel. Do well to subscribe to our channel. Do well to like and then share our videos so that we get more engaged on this channel. So I'll see you next week where we discuss the regulatory and the conceptual framework of what? Accounting. So in absence of that, bye-bye. Hello guys, you are welcome back to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting.